Hey friends, welcome to this month's webinar. We're calling this one Jargon Jeopardy. We're going to have a lot of fun today. We're going to talk about some terms and we're just going to have a lot of fun with this one today. Hopefully the goal of this is to give you some education so that next time you're investing in a private placement offering, some of these jargon words will have a better meaning for you. And I'm going to try to keep this lighthearted and fun and just upbeat. If any questions come in, if you guys have any questions, please drop them in the chat. I'll get to them either throughout the meeting or at the end. We'll save time if there's any questions that I haven't gotten to throughout the meeting. With that, let's dive right in. You guys, there are a ton of weird jargon words and acronyms and abbreviations and things like that that people use when we're investing in real estate and different funds and different types of investments. And again, the goal of this is that you have a full understanding of each of these things when we're done. So let's what are you going to walk away with, right? So you'll be able to understand some of these words, speak syndication like a pro, and understand how these returns actually work. The third bullet point is one of the most important, right? Know who gets paid and when. That's something that you really need to understand, and that will help you evaluate deals with confidence, as this slide says. So here's what we're going to cover today. We're going to talk about the money map, how returns are measured. What do these returns mean, or what do these terms mean when we talk about money? Then we'll dive into the deal structure, how different deals work and what the different structures mean. And then at the last, we'll dive into some legal framework and some legal questions. All right, so let's start with the money map. First section we're going to talk about is cash on cash returns and why it matters and how it works. Okay, so this is really simple, right? Actually, we're using $100,000 here because it's a round number, right? So cash on cash return is money. You take the money you put into a deal and then the money you're going to receive every year on a yearly basis. That is something that you need to understand, the difference between cash on cash and average cash on cash. I'll explain that in just a second. So cash on cash return is measured on an annual basis. So this example here, if you invest $100,000 and you get $8,000 per year, then you're getting 8% cash on cash. You guys, that's not how most of these deals work. They're not usually a straight cash flow. Now, sometimes when we do a debt investment, you're going to see truly a level cash on cash return. We see these anywhere from 10 to say 15% right now. And those are going to pay out a consistent amount. But most equity deals we do, maybe the first year, there's really low or no cash flow at all. But then it starts to grow. Maybe in year two, it's up to say 5%. And then in year three, it's say 6%. And then in year four, it's say 7%, right? And then we exit in year five. So you got to understand this is projected on an annual basis. If you see average cash on cash, that's going to take the amount that you get on an annual basis and it's going to average that out throughout the year. So in that example I just gave you of like say 2, and then 5, 6, 7, and 8, maybe that comes around 6.5% cash on cash. I didn't prepare the exact math on that, but you see the point, right? The next one is really very, very different. So internal rate of return, what this is going to do is it's going to give you take the total return that you've gotten, but then you have to also understand how each time frame is broken down, because what this does is it uses the principle that money today is worth money more than money tomorrow, right? So it takes in inflation into account and also the velocity of money. So, if you see an average annual return of say 20%, you might see the IRR be as low as 16 if it's all coming at the end, or it could be even a little bit higher, 21, 22, if more of the money is coming in the very beginning. IRR is my favorite return metric to use because it uses time to help you understand. It's also one of the hardest to calculate. You're probably not doing this without Excel, okay, or something like that. The rest of these ones you can probably do in your head. But this one, my favorite. The next one is really simple. It's equity multiple. If you add up all the money you've gotten throughout the hold period, right? All the cash flows we talked with average cash on cash. And then when we exit, we sell the property and you get a big pop of money. You add all that number up, all those numbers up, and you could compare it to the amount of money you invested, right? So in this example, it says over here on the right, if you invest 100,000 and your total cash flow back to you is 200,000, that's a 2x equity multiple. A lot of people really tout this as one of the most important metrics, and it kind of is, right? But a 2x equity multiple means a lot more if you can do that in 2 or 3 years than if it takes you 7 or 8 years to do it, which is why I prefer the IRR number over equity multiple. This next one probably maybe should go in legal terms, because it doesn't directly, it's not actually a type of return that you're going to get. What preferred return means is you're going to get this percentage before the general partners in the deal get any money. Okay, so what that means is, let's just say they've given you a 6% preferred return. That means that you have to make 6% on your money before the general partners or the other people in the syndication get any money. And if they miss it, let's just say you're at 6% and they only give you, say, 4 in the first year. Well, that last 2 needs to carry over, okay? And so now in year 2, they essentially owe you 8. So let's just say they give you 5 in year 2. So now 3 points would carry over. So now in year 3, they owe you 9. And now if you get 8 in year 3, now they owe, 1 carries over. And then in year 4, that drops back down. And now they only owe you 7, right? Because they owe you 6 every year. And if they don't pay it, then that usually, almost always, stacks on top of what's due the next year. What it doesn't do really, though, is compound. That's very rare to see it compounding, but it does stack. I hope that makes a lot of sense. Obviously, if it doesn't, feel free to drop a question in the chat. I'm happy to explain it again. So you guys, those are the return metrics and really how those work. Next, I want to talk a little bit more about deal structuring and some key things that you need to understand about the deal structure before you move into an investment of this type. So when you're investing in a 506C type of investment or a 506B type of investment, the ones that I typically do, you're going to hear these terms a lot: general partner and limited partner. Here's the way I like to explain this, okay? And it really comes down to risk, okay? Risk and reward, really. As an LP, a limited partner, your risks are essentially limited to the amount of money that you invested. So let's just say you invest 50,000 into one of these deals and everything goes wrong. That $50,000 is your risk, right? So that 50,000 could go to zero. But if everything goes amazing, your returns could go through the roof. I mean, every deal is going to be different and the returns projections are there, but it could be 2 times your money, 3 times your money, depending on the deal, right? You get paid based on the amount of money you put in because you have limited risk. And that also limits your upside because of you're not getting the sweat equity, right? A general partner, a GP, now in a GP stance alone, they're not putting any money in. They're doing all the sweat equity. And if you have limited risk, then the general partner has general risk or all the other risks, right? So we're the ones signing on the loan. We're the ones that are, actually buying the property. We're the ones that have to deal with the tenants, the termites, all the troubles of real estate. We're the ones that have to deal with all of that extra work. And we put in the sweat equity to get it, which is why we get money for putting in that work. And then we also have all those risks for being on the general partnership side. Now, a lot of times, most of the time actually, the general partners will also put money on the limited partner side. So they're on both sides. But you really have to look at those two things as separate investors or separate entities, really, right? So if I'm on a general partnership side of a deal, I'm going to get paid for my sweat equity and that general risk. And then I'll also put money in the deal on this side as a limited partner. And so I'm taking advantage of both sides. Just something to think about there. This example really helps this too, to really understand it. If you think about like a three-tier cake or a four-tier cake, right? And every single layer are different investors with different risk profiles and different return profiles as well into a deal. Next, I want to talk a little bit about the capital stack. And this is going to seem similar, but I want you to know that it's very distinctly different. Here we're talking about different types of investors. Here we're talking about where the money actually comes from. And I've talked about this before, and I really want to hammer this home so that you really understand it. The capital stack is where all the money comes from to do this deal, right? So if we come over here and we look at this pyramid, the base of it is very often, almost always, what we call senior debt, or the main loan to be able to buy the property or the business or whatever we're doing. Now, we do see some deals where there is no senior debt and it's all cash, but that's pretty rare because leverage is very, very important, right? So something you're going to see on senior debt that you've got to pay attention to is LTV, or loan to value. And usually what we're seeing, at least in real estate deals that I do, we see anywhere from 65-ish% to 75, maybe once in a while you see 80%. 60 to 80 is like most common. Now, there's pros and cons with that, okay? Loan to value. The higher the loan to value, potentially the more returns you can make on a deal, right? Because you need less capital and you have greater leverage. But it also increases the risk or potential risk on a deal, right? So you can see something and you can see a 60% loan to value and an 80% loan to value deal. If the returns are exactly the same, or the projected returns are exactly the same, you should go with the 60% loan to value deal because it's less risky, right? So you just got to really understand what the loan to value is with the senior debt. This next level, mezzanine debt right here, this is like getting a second mortgage, right? Or a second loan to be able to buy a property. So relate this to a single family house. Let's just say you go to a bank and you can borrow 70% of what it costs to buy the house, but you only have 10% of the money in cash. So now you go to a second bank and you get a loan for 20% of the purchase price to cover that gap. Just as an example of that's kind of how these work. Usually you're going to see mezzanine debt is going to be at a much higher interest rate because they're in second position. So it's a less secure position for the bank or the lender. And so those are going to be a little bit higher. And then it also impacts LTV, right? So you need to combine the two of these to get the full loan to value of a deal. And then you also want to blend the rate together when you're doing your own underwriting. If the senior debt's giving you, let's make something up. Let's say they're giving you 6% interest, right? But then the mezzanine debt's giving you 9% interest. Can you average those two together and be at 7.5? Probably not, right? Because the senior debt's going to be a significantly higher percentage than the mezzanine debt. I just gave you the example in a single family house. 60% of the debt would be at the lower interest rate. 20% of the debt would be at a higher interest rate, right? So you got to blend those together. So maybe your rate's like 6.5, 6 3/4. Again, I didn't do the exact math. This isn't a lesson in underwriting. This is just to help you understand the difference between senior debt and mezzanine debt. All right, next one, preferred equity. So preferred equity is like, again, back to the single family space. Imagine if you had a hard money lender. That's the closest way, the closest analogy that I can come up with for mezzanine, or I'm sorry, for preferred equity. What this is it is not technically debt. It is technically an equity investment, kind of like an LP makes, but they get like, well, in this example, third position, right? So the senior debt gets paid first, and then the mezzanine debt gets paid second, and then the preferred equity gets paid third. And then common equity, this one at the very top here, right? This is where you and I are going to invest. We're the limited partners. And so we're at the top of this. All of these other people, their returns are almost always capped, right? The senior debt knows exactly how much they're going to make. The mezzanine debt knows exactly how much they're going to make. The preferred equity knows exactly how much they're going to make. And we're at the top. We typically have unlimited profit, even though it's projected, unlimited potential profit, excuse me, even though it's projected and we're going to be in these kind of ranges, we get the highest reward because we're taking on the highest risk, right? So again, on the bottom, senior debt is the most secure. They get paid first. Common equity or LP investors, they get paid last. And to really understand that, you've got to understand this next section, which talks a lot about distribution waterfalls and really where this lands. The term distribution waterfall really just describes exactly what it says. Who gets paid in what order, right? Who gets paid first, who gets paid second, who gets paid third. And if you have to go back and all of this fits into that, that section of the waterfall. But then when we're in this common equity here, right, there's a few terms that you need to understand. And I want to talk about all three of these: return of capital, preferred return, and profit splits. Okay. So return of capital is something to really, there's a lot of nuances in this term. Okay. So when you're talking about return of capital, I can think of three things off the top of my head that are really important to understand. First of all, soon as you get your money back on a deal, you've essentially de-risked that. So when you want to understand how long is it going to take for you to get your money back, that's something that's important. But then you want to understand how are those returns taxed? Often, the first returns you get are considered a return of capital, so they're not taxed. It's you getting your money back. And again, this is just a bookkeeping trick, but what it does is it delays your taxes or your capital gains out into the future longer, so you can keep more of your money now. Makes it more of a tax efficient vehicle. But what you really want to watch out for is, are those returns considered a return of capital for calculating the preferred return, which is the next term I really want to talk about. I know we covered it a little earlier, but I want to highlight it again. A preferred return means you're going to get a certain amount of money before you have to deal with profit splits, before the general partners make any money. Okay. And so really what a preferred return does is it puts your interest as the investor ahead of the general partners, which is not a bad thing for you. Okay. So after the preferred return is met, then they're going to do something called a profit split. Okay. So if they're giving you 6% on preferred return, which is the example I used earlier, I believe, what they have to do is they have to pay you 6% on your money before they take any money. The GP takes any money. And when they do that, once your preferred return has been met, then they're going to do something like a 70-30 profit split. That's only an example. It's one of the most common profit splits you're going to see. But what that means is that 70% of the profits after the preferred return's been met goes to you, the investor, the LP. And 30% is going to go to the general partnership. Now, sometimes you see it 60-40, so it's 60% to the investors, 40% to the GP. I've seen some deals where it's as high as 80% to the LP. That really doesn't matter necessarily, that profit split on its own. You really need to understand all those other components, but it's just something to pay attention to. How much of the profit are you getting going forward? Something to think about. And that 30% in that example that the GP gets, that goes right into our next slide, which is what's called the promote, right? The promote, or another way to call it, is what's called carried interest. This is where the GPs and how the GPs get paid. A promote means GPs get X amount of dollars for putting this deal together. It's usually mostly that that 30% in the 70-30 split. I gave you an example earlier, but it also includes some fees and some different things like that. But what the promote really does is create alignment, right? You, the investor, has to get paid before the general partnership gets paid. And so that way your interests are aligned. The more money you make, the more money the general partnership makes, or at least that's the way they're supposed to be structured. Okay. So that's enough about those terms. Let's talk a little bit about some more legal stuff. And you guys, we're flying through this. So we're almost done. We got like 4 or 5 more slides. This is going to be a pretty short webinar, it sounds like. So legal framework, red tape and reality check. You guys, there's a lot of things to talk about in the legal. Really pulled out the most important slides or the most important sections to really talk about. And I think this is the most important thing, is this myth over here on the left. I hope you guys understand you do not need $1 million to invest in real estate or any of these other funds. That's my number one. The number one objection I hear is I don't have enough money to invest in real estate. Okay. All you need to do to actually invest in these types of funds that I do, you need to qualify as an accredited investor, right? That's up here. And I'm going to do a whole webinar about how to qualify as an accredited investor. But there's 3 or 4 different ways to qualify. These are the most common, right? The first one is income. If you make $200,000 a year of income, if you're investing alone, okay, single, then you're accredited. If you're investing as a married couple or a joint investment, then you have to make $300,000 together, right? So what does that mean? If a husband makes $210,000 and his spouse makes $40,000, that husband can invest solely as an accredited investor, right? But they couldn't invest jointly as an accredited investor. They'd have to combine be over 300, 150, 150, 200 and 100, whatever it comes up to be 300,000. But what I'm seeing most people do these days, they're qualifying as this $1 million net worth example. You guys, and when we're talking about $1 million net worth, it says right here, you can't include your primary residence. Like I can't include this house I live in, but I can include everything in the house I live in, right? You can include your art collection, your silverware collection, all of my books, my bookshelves, my furniture, my cars, the gold that's hiding under, somebody's bed, or, you're definitely your 401k. And if you own a business that generates any amount of income, that business has value, right? So getting to a $1 million net worth may sound daunting, but when we actually put it together, it's not as hard as it sounds, okay? A couple more ways. If you're a licensed financial advisor, Series 6, 7, 65, 66, 82, one of those types of things, then you're automatically accredited. And then there is a thing about if you invest $200,000 at a time, then you could qualify as accredited. That one, it's loopholes. And so please talk to me about that specifically so we can dive into it. And then something that's coming, supposedly, the SEC has been talking about a test for the last couple of years, that anybody that can take this test will automatically qualify as an accredited investor. That doesn't exist yet, but it's supposedly coming soon. And if that's important to you, I suggest you write your congressman and tell them. So that's how you qualify as an accredited investor. Once in a while, there are deals you don't have to qualify as an accredited investor. In this one, you qualify as what's called a sophisticated investor, means that you possess sufficient knowledge or experience to evaluate investments. You guys, at the end of this, I'm going to give you a QR code and a couple more slides. You can download a 7-day passive investor course that I've put together. That 7-day passive investor course will qualify you as a sophisticated investor. All you need to do is show that you have taken the necessary steps to educate yourself to qualify as a sophisticated investor. Pretty easy. But again, not every deal will allow that. Let me break down the 2 most common types of deals from a legal perspective that you're going to see when you're looking at these passive real estate investments or fund investments, right? The 2 you're going to see the most are 506B and 506C. There's a couple other ones out there, Reg CF, Reg A. We're not going to cover those. They're very rarely used. And yeah, I think this will give you everything you need. Okay, so first, 506B. Most people that are in my business, they start doing 506Bs. This is what's considered a friends and family offering, basically. Okay, so it is a private offering and it is relationship based. What does that mean? You can't advertise. That's the rule. Let that sink in. How do you prove you haven't advertised? Well, the way to prove it is to say that you have a substantive relationship with the investor before your deal was put together, right? So, my sister, I have a substantive relationship with her. My accountant, my neighbor, I talk to my neighbor pretty regularly. There's a lot of rules about this, about how you qualify to have that significant relationship. But you have to have that to be able to invest in a 506B deal. It does allow sophisticated investors. Remember, we explained the difference between an accredited investor and a sophisticated investor, but it only allows 35 of them in the entire deal. So you can have as many accredited investors as you want, but you can only have 35 sophisticated investors. And the barrier to prove that is a lot lower, right? It's self-testifying. You self-testify whether you're accredited or not. But again, you can't advertise, so you need to have that relationship. So 506B over here on this side, right? 506C rather, very different, very, very different, okay? 506C, you can take out a billboard. You can run ads on Facebook. You can put a yellow page ad. You can do smoke signals like they used to do with the airplanes, right? You can publicly market a 506C deal as much as you want, okay? But you can only take accredited investors, right? Go back to this slide we had just a second ago, $200,000 in income or $1 million net worth. Every single person that goes into a 506C has to meet that qualification. Now, most people, like I said, when they start in this business, they do 506Bs in the beginning, and then they move over to 506Cs. That's really the way the progression has happened. All of this is covered in the PPM. PPM stands for Private Placement Memorandum. You guys, this is the contract that you have to sign to invest into a deal. This is where it's going to outline all the things on the screen, the risks, the terms, the structure. It should also have in there the projections, how much money you could make on your money. A lot of times you're going to see the actual presentation that you reviewed is actually embedded as an attachment. This is where you're going to see how long is the investment going to take. This is where they're going to talk about any kind of capital calls that could happen, where they're going to talk about, again, the risks, the rewards, the structure. This is the document that controls the legality of the investment. Now, I'm going to tell you, and every good syndicator will tell you, you need to read this and you need to understand it. They're close to 100 pages sometimes. The shortest one I've seen is like 45 or 50. Longest one I've ever seen is probably 120 pages. I will tell you to read it every time. If you do, it's up to you. If you don't, it's up to you, right? But I will tell you to read it every time. All right, friends, we have covered a lot in this webinar today. We talked about, the money and the different types of returns. We talked about the capital stack and how the money all lines up. We talked about some legal mumbo jumbo words. And I must have covered it really, really well because the only question I got, I answered on the next slide before. So with all that said, here's how to get a hold of me if you have any more questions going forward. My email address, my phone number, my website are all there. But the best thing to do is scan this QR code right here. This guy will take you to a list of links where you can get my 7-day passive investor course, so you help you qualify as a sophisticated investor. And also you can download my contact information, see all my social links. You can even book a call right here on this QR code. So friends, I really appreciate your time today, and I look forward to being with you next month where we have another really exciting topic. Thanks for joining us. Talk to you soon.